We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Francis Hunt, the Market Sniper, CMT in technical analysis and founder of themarketsniper.com. Francis, thanks for joining me today.
Delighted to be with you, Tom. Thank you for having me back.
It's always a pleasure. You know, you and I go back quite a ways here. Of course, we did that excellent trip to Africa that we were just chatting about a little bit, kind of reminiscing here before we hit record. You know, I think that was a lot of our listeners' one of their favorite episodes, as I had the privilege of meeting a bunch of listeners in person at a conference recently, and they all kind of said to me that the recording that you and I did in the vehicle on the trip down to Cape Town was one of their favorites. So, you know, it's always good to catch up here.
Oh, absolutely. Two authentic lads having a chat, a nice road trip after a great riding holiday, and sharing a little bit of a mix of the things that manhood are all about, as well as a way of the world. It's got to be a great discussion. And thank you for being the other part of that, because it takes two to tango, and you're a great host.
Well, you know, Francis, it's interesting to be able to step outside of just the financial world that you and I deal with every day, and kind of be able to show another part of the rest of life that's extremely important to me, and I know it is to you, to be able to enjoy and to be very deliberate about experiencing, rather than just being stuck in our phones or our computers all the time.
100%. And I think, you know, just while we're on a bit of a philosophical angle, and it sometimes comes in at the end of my videos, I try to say something along these lines, but why not at the start? You know, the quality of your life is usually dictated not by how many beans you've got in some monkey money bank account somewhere at the end of the game, but the quality of the experiences you get to have had with the time allocation you get given, and how much you were actively in the moment and appreciating them with both others, because a shared experience is an amplified one as far as I'm concerned. And we did something together as people that just met across the internet until that point. And we had, you know, 10 days of really intense riding. There were lots of blasting through riverbeds in the sand. And I've got real hard, tangible memories that I can't put a price to, that you were part of experiencing with me. And we have that connection now forever, as brothers of the trip at that point in time. And for some of the things that we might say that may seem somewhat negative in terms of the way of the world and what it might be turning to, it's always important to remind people of exactly that. Build those bonds, have those shared memories, savor them and relive them, and be intent about making some more. And I will remind you, your bike is still out here under good cover, and it's waiting for you to visit again and to take it on its next trip along with your band of brothers.
Absolutely. You know,
or sisters, for that matter.
Yeah. Well, you know, you kind of bring up this idea of community, which I think is super important. And you know, hopefully one day we're able to kind of share that with a couple more people, because I think that, you know, we're not alone in seeing the world the way we do. And, you know, just even between you and I, never mind the community that you have this ability to be able to pick up on a lot of different pieces of data from that community. And I think that is a very powerful way of living and being able to understand the world through this community that sees the world in similar ways, not the same way, but similar ways that you and I do.
Oh, absolutely. I think the thing is, you know, you need the core like-mindedness, but there's many different talents, many different minds. And as I always say, it's not about the leader or the person behind it. It's the hive mind capability of everybody in that. And actually, a leader's role is to actually stand out of the role and make sure some of the people that are most saliently skilled in a particular area that are bringing that same mentality of understanding the great game, some of the things they're bringing to the fruition. So I'm continually being upward managed, if I am anything more than just another member of the community, upward managed and upward informed by those around me. I have people, and I understand the US far better for my US members. I understand the Canada better for my Canadian members, and many amongst them, some of them will be medical, technical, IT, and all of that. So it's absolutely spot on. And I think the minute you get the normies out and the judgment, and you have people that are all free to speak and to speculate. We are all speculators in every form of life. People think it's just traders that are speculators or investors that are speculators. We're all speculating on future outcomes. Just hoping that the sun comes up is a speculation when you go to bed. And the more prepared you are, the more aware you are. I don't find it a tax. I see it as a gamification of life. And play your best game. Play your best game, and you're going to mess up and fall on your face. And you have a number of lives that, in other words, you'll break a rib on a bike, and you've used a life maybe. You'll do something like that. But don't for naught of wantons of living and seeking to do that, and connecting with people that are of like-mindedness. The like-mindedness is very important because you can't have too many rogue elements of skeptics or normies that make people afraid to speak and speculate out loud. And I'm all for people that speculate out loud. I love people who have theories. I try add to them. I point out where they're weak, and I build models. It's all about building models of the future, into the future, about the future. And our discussion around gold and silver, which is where it all began, is based on the financial assets, the financial balance sheet, and how best to preserve yourself from a monkey money game that is being proliferated and is in the final stages, that they're literally stripping the last valuables off the Grand Hotel out. And that's what I'm seeing where America is now. You look at the Biden and the Russia confiscation. Well, Russia's going to be tit for tatting on that one, and assets are going to get lost. So it's intent. It's actual intent. Everyone will go, well, Biden's stupid. He's not making any decisions. Nobody really believes that. So it's intent. It's destructiveness towards the system. So the Fiat endgame, in fact, I've asked one of my staff members to help me draw a drawing that I described, because I have this model in my mind that helps explain so many things with images and phraseology and fun that's entertaining as well, because we want to laugh our way about it. I tell you that graveyard humor is absolutely the order of the day. It's a game. I'm going to laugh. You're shooting a man in the little video machine game at Space Invaders. Call it what you want. Don't get too hung up on various things. There's going to be amazing opportunities. If you keep your humor and you keep your sound mind and you hold on to sound money during this period, you come out a champion. You come out a winner, even if the world is half what it used to be. And I'm not saying it will be. And that's part of why we ended up talking about gold and silver, which is only a small segment of thriving into this transition, because we are going through one heck of a transition. And certain things are being managed into their terminal decline. And you've got to recognize that. You've got to see, and the amazing thing about this is you need the snapshot mindset. Because if you watch the video, they're doing so many frames per second right now. Each frame is only marginally worse than the previous one. And you don't notice it. It's like a Mandela effect that you're getting continually repeated to you, but it's twitching slightly and moving away from you. You need to be able to snapshot where you once were and see the direction you're going, measure that trajectory, stand back from the continuous movie, which is your social media that you were referring and everything, and go, geez, the topic of the conversation is this. We would never have discussed that 20 years ago. We were all of a certain value set then. And I think if you can recognize that, then you just have to be able to say, where does this end? And it's a total global surveillance communism that will be run across most nation states. But like everything, it'll be imperfect. There'll be arbitrage opportunities. And a rich slave always lives a better life than a poor slave. So build your wealth, get your freedom, get optionality across many geographies. And gold and silver is part of retaining your balance sheet, but there's so much more to it than that.
Mm-hmm. I 100% agree, Francis. And, part of what we're discussing right now is this idea that you need to be able to analyze the world for what it is, not the world that you want it to be, and be able to take action based on that. I understand it can be a very scary thing, but we're never going to be worse off for understanding the trajectory that the world is on, number one, and then on top of that, be able to act accordingly and keep yourself somewhat insulated from the ramifications that the powers that be are ramming through.
Oh, absolutely. You used brilliant phraseology there. The trajectory of the planet is not your wish list. It's being flown. This plane is being flown by other people. So, you can get to decide how you sit, whether you're in the brace position on impact or not, whether you know where the luggage is and all your goods will be once it's been smeared on the runway. But you're not flying, you're not managing the detail of the direction. And the great wisdom actually is not to Stephen Covey said, understand those things and factors which you control, mm-hmm. and recognize quite clearly the ones you don't. I can't control who becomes Prime Minister of Canada, US, or South Africa, or any of the nation countries that I choose to live in. Don't waste any energy on affecting that. By the way, they're all probably having elections this year, and I couldn't give a monkey's. You'll change one criminal for another. If there's even a slight modicum of health, there's nothing that voting will change for you. You don't vote yourself freedom at a ballot box. You fight for it, you earn for it. Unfortunately, you bleed for it. And as long as people are trapped in that paradigm, they're going to muddle on. I spend no time invested energy. Once you understand the game, you can keep your intellectual power, your processing power, laser focused on the things that actually you can affect. And that is how you respond to everything. You might not be able to affect the environment and what will happen to you, but you can affect how you get to respond from it. And preparation is a vast amount of that. So again, optionality, all forms of citizenships, tax residency, these are discussions that people need to have, as well as just the gold and silver discussion. I know you're going to have a strong gold and silver here, and it's a massive part of the solution, but there's so much more. And by the way, the least thing that I expect is all my plans to work out. I expect many to fail. Mm-hmm. There's some things that I don't even know that they have that will undermine us on various levels, but I just need a few to work out. And also the process of preparing is incredibly emboldening and is incredibly mentally uplifting. Many people lose the game through a sort of collapse nihilism. It's all hopeless. I think I should shrink up and eat worms. And you've got to attack a difficult obstacle course, but you will finish it if you take that mentality. If you don't even start it, you'd never know if you finished it. The final obstacle might just be around that muddy bend, and you were almost there. So you just keep on keeping on. I'd certainly say that. And we don't own that environment, but we own the response to the environment.
Yeah, as you're kind of touched on in that answer, I saw this quote the other day, and it says something to the effect of, you cannot choose what happens to you, but you can choose how you respond to it, right? You cannot choose the circumstances that arise in your life, but you can certainly choose to respond to them in a position of power rather than a position of weakness, right?
And I don't want to put myself as this major model of fortitude as well. I absolutely take an 8 count regularly on things. We came down here, I got kind of sick, had runny stomach, run down, geysers didn't work, moved into new house, all these things are not happening, and breaking, leaking roof, all of that. I had my stuff this moment and feel I should, complain, a previous owner, contractor, this and that, and all of that, fight, throw a hissy fit, stamp my feet, bawl like a baby for a bit. And I do all of them. I do absolutely all of them for a while. Then I slap myself up a bit, cold shower, and then I say, okay, how do we go forward? What's the solution? You don't really need to make enemies with a whole bunch of people just because you've lost your emotional control for a while and you don't like the situation. It shouldn't have been that. You've been a bit unlucky here or there. Now you go forward, and actually it's nearly always an opportunity in that. It's nearly always an opportunity. By the time you're done, you go the high road, you go the hard road, you do a major gut and refurb. It's a popular area. Property value shoots up. The money you would have had in the bank doesn't get stolen with a bank collapse. Instead, it's in something that's now gone up in value. And you suddenly look back and you go, man, all those things that freaked me out for those 5 minutes. So I also don't want to put myself forward as somebody who's just straight away square-jawed, chest out, and charging up the next hill. We all entitled to, wobble. But once you're done and you've had that first proper sleep afterwards, and you've picked yourself up off the more, go forward, and you just win. You can be wrong. It's shown that a positive action person, because there are a lot of people who talk positivity, and I'm not a fan of talk positivity. I talk about a lot of dark topics and things that aren't going well and aren't going to do that. But there's a big difference in outcome for people that are pessimists and take low level of action versus people who are action optimistic, which is how I describe myself. I'm not overly optimistic on the direction of the world, but I'm pragmatic and realistic on that. And I do a very dry scientific analysis of it. But by taking action and being optimistic, action optimistic, you harvest, even when wrong, far better outcomes than someone who's accurate and passive negativist. So it's just better. It's just better. How do I win? The question comes back, how do I win in the situation that I find myself in, even if it looks like a 6-foot hole?
Well, I appreciate you acknowledging that and making sure that, everybody's able to understand that you and I are, definitely far from perfect. But again, we're all human, and we all need to, again, realize the world for what it is rather than what we want it to be, and act accordingly. So Francis, let's move into talking a little bit about this, I think as you put it, this debt and fiat contraction that we're currently looking at. How is that manifesting through the world right now?
It's such an excellent question, and I'm delighted you asked it. So I'm going to draw with my hands, and I'm going to promise everyone diagrams in the future, because I've literally asked teams to draw this for me. So there is a world that is fiat, paper, and I would also say digital 1.0. So first version. That is like this brown paper bag. And inside of that, you have lots of little fish bowls, which are nation states, with water levels. And in the water levels is a seesaw. And you'll have the dollar and the UST debt are on opposite sides. So money is borrowed into existence. So we've got a lot of guys that have been very proud nationalistically, it's kind of Twitter influencers, not the average American dollar strong, they'll say. When they brag about that side of the little seesaw being strong, in their water fishbowl, underwater right now, is the debt, the American debt. So the dollar's got strong on a higher escalation of rates. And as a result, they've handed a bigger destructive force to their debt markets, because the increase in the rates is also a decrease in the debt valuation. Mm-hmm. Japan, the opposite one, is this also in its own little fishbowl, also with a very high water level, with its little seesaw and a fat man and a thin man on it. Only the fat guy is sitting on the currency end, and he's underwater. Mm-hmm. And he's glugging and looking for a snorkel to just hang on. And the debt is being artificially maintained at an artificially high level. So each fishbowl has too much water in it, that's debt, and are playing the devaluation in both ways. You're going to have to devalue both debt and money, but some are choosing to allow the debt to devalue and bragging about how strong their currencies are. Again, not the average American, not most people watching this, but you'll have some influence, dollar strong, all of this stuff. What they're actually saying, debt down. And you'll have the guys that'll focus on currencies, yen weak. But in actual fact, its debt hasn't taken a bath yet. If I were to just do a quick share of the debt of the 30-year and how it's looking so far, a great reveal of a chart for people to have a look at. So when people, and I'm maybe having a go at like the dollar milkshake guys that are saying dollar so strong. Yes, the dollar will win by destroying everything for a while as part of its journey of collapsing as a fiat paper digital. So we've created this brown paper bag where we have all of these assets, and that whole universe is contracting. Now you can take the contraction in your currency, or you can take it in the debt, but you're going to have to take it in both ways because money is borrowed into existence. This is a 45% loss in value since July 2020 for the 30-year Treasury. That's 45% loss in value. The Japanese debt's barely lost anything. I think they've gone from 0.1 to 0.45. But their currency has been the whipping boy of the first world tier one nations. And in between that, you'll have Britain and Europe, where they've both gone down a degree, and the seesaws are a little bit more level. So that's in the brown paper bag: fiat, debt, and digital Mark I, your digital money in a bank balance. That's actually no cash, no paper. It's just a number in a computer somewhere. That whole realm is contracting with all the different nations, fish bowls in it, that are allocating which one they're doing the bigger damage to for now. What's outside of that universe is physical things. Gold, silver, land, unencumbered by debt property. That means a particular, I'm highlighting the best ones. Property without debt. It will still go down if the rest of the market is indebted and has to sell off, but eventually it'll bottom and it'll continue to serve you as a home and can generate a yield for people that need to rent. Other assets, copper, industrial metals, commodities. I'm the least bullish right now on energies because the consumer is wrecked. So I have a different model for explaining the economy in terms of consumer and statist enterprise. That is a balloon that's been twisted in half by the clown that's making a dog for your child. And in that one, the air that's on the man on the street side is all being driven into the statist side. So most of the big spending is governments on military industrial complex, pharmaceutical industrial complex, media industrial complex, all surveillance, so facial recognition at your airports. You're not getting a new airport. You're not getting a new hospital. That's too useful for the man in the street. What you are getting is facial recognition cameras at your passport control. You're getting biometrics in your check-in systems. You're getting all the components of surveillance, finance, statism. And the companies that are bringing that, the tech companies, or the social media ones that are scanning all your images that you're uploading, et cetera, these guys are getting fat and rich on government contracts and some big commercial contracts that are also getting government contracts and need, across supporting each other for tech services, for marketing, et cetera, that all the big oligarchy that are essentially status created. Many of these things were seeded almost in the CIA, the NSA before. The LifeLog for Facebook, you had Bitcoin equivalents making a mint paper in 96. You've got all of these things. Now, out of this shrinking paper bag, you've got two exits that are going into one new container, and it's digital 2.0. This is no longer money in a bank part digital. It is blockchain, UBI, CBDC, all some of those surveillance finance things I've mentioned. And there's a fat pipe going into the high side of the digital 2.0, where all the corporatocracies are spending money and they're re-inflating this other bouncy castle that we're all going to get moved on to. Mm-hmm. And the air's been taken out of the one that's contracting on the nice fat side, and all these corporates are coming in the top. And at the bottom, there's for the lowly people, men in the street, are going to be shuffled into the bottom end of the new hierarchical castle, digital 2.0, which is going to have all the aspects of the old world, only more digital control from a computer remotely. And in that is tokenization as well, which is a weaponized tool to get to own via derivative proxy your physical stuff, which is outside both of these. So your motorcycle in RSA, it's only Tom's. None of my mates who've helped storing it or anyone wants to touch it. It's waiting for you to come out there and ride, and it's yours. Problem you will have is in the future, everything we'll buy will end up coming out with a digital token that'll be hosted in a blockchain, a UBI, on Hedera Hashgraph, or whatever the case may be. And anyone can check and investigate who owns that asset, and anyone who can proliferate all the new beans of the new monkey money currency in a digital world can purchase everything and rent it back to you. And they can do a groundswell quantitative easing because they can print up however much they want, and they can purchase everything from everybody. And in one sweep of digital maestro magic, you become a rentier of something you once owned. And you get told, hey, isn't it awesome? Uber has no cars. Airbnb has no homes. This is the best model for things. You don't need to own things. It's so 80s of you. You should be happy on a just-in-time, when you need it basis. And they make it super convenient, and your driverless car will pick you up and take you to the airport and drop you, and you don't own a car anymore, and it's a battery, and it's like a big iPhone, and it surveils you the whole way in. And if you've got any unpaid speeding fines, it delivers you to the police station on the way. All of that. And that's the concern. That's the concern and worry. So that's my model. The deflating digital 1.0 that's been pushing the air into 2.0, which gives ever more control on how much meat you eat, right the way down to social scoring, etc. And you need to be out of both systems. So there's a breakout, jailbreak exit, which is physical gold, silver, and land, and owning it, and rejecting and pushing back against the eventual tokenization of that ownership, which will actually probably come with a pre-agreed sale agreement and everything else to make it convenient for you, you understand, so that your asset can be removed from your possession and made somebody else's in a real-time transaction in the future. Only the main buyer of that will be the corporatocracy, the people that are actually behind your governments and running it, like Vanguard, like BlackRock, and everybody else that will seek to own everything, see you own nothing, and tell you how happy you should feel by not being encumbered by those boring assets that had your name on them and had all these things you needed to do for them. And that's a dangerous direction. And that's the trajectory I see. And as I say, I've got a number of phase diagrams for explaining that. And going back to finish, just before I hand back to you, the seesaw analogy is eventually the seesaw goes around and around, and you bring both sides dunked into water like a windmill. Mm-hmm. And eventually the fulcrum snaps because both ends are too fat. And what you get is what Britain had a short moment of, which was when the currency collapsed. The debt was collapsing because no one was buying it. And as a result, pensions were in a state of collapse. Everything based on debt, which will also include the banks because they're the intermediaries of money, which is also the debt system. And that is the snap of the fulcrum. The wooden pole eventually breaks on the triangular fulcrum to both sides. And that is the deflation of both. And what happens is I think the yen is going to let their currency go, but the eventual breaking of it will be the sudden collapse of their debt, which is clearly hyper overvalued and should be rated far lower. Snap, that's going to be the thing that snaps. And in the case of the dollar, that's going to be at the vanguard of the rate rises and generally firmer. It's going to be the debt devaluation, which is going to keep being at the forefront going down. Suddenly the dollar strength snaps like the yen's debt will snap. And then you have two snapped arms, both underwater, both drowning on the fulcrum, and the water level keeps rising because the rate at which new debt is being created and the degree of expenditure versus income continues to see deficit spending, and that sees the fishbowl continually in the point of always going up. And each nation state is their own fishbowl with their own rate of water level rising, with their own seesaw with fat kids on them. And we're at the point where certain things are going to be allowed to snap on both sides. Mm-hmm. At the moment, we're seeing one. But the entire set of all the fishbowls of the nation states are all in an elevator shaft falling. And the way you don't lose value is you have that hand on that 10th floor on the gold bar, and you watch, so you go long with your trading. Everyone was going, what a trade that, we were the first to call it, the USD JPY. But I'm seeing the milkshake guys saying, look how well dollar, yen. And if Japanese people had sold all their yen, they're obviously taking it since 2021, so they're very selective on time period, sold all their yen and bought US treasuries or had dollars, they wouldn't have had any inflation at all. They're selling this as a virtue almost of the dollar-based system. And that's, well, you chose the unique set of period where the yen has been in a specific decline, yes, and that point holds true for that data. But since the 70s, the yen has clobbered the dollar all the way down until the high, and the pound and all the other currencies. They were the World War II, post-World War II miracle. So it's selective data, and your treasuries have lost 45%. So you would have had to sit with bank money, not in a treasury, and earn maybe a money market or something. Then you've done a little bit better, yes. But go and look at the same yen gold setup and go and have a look at the dollar gold price. And you've actually lost 97% of your buying value in the dollar. So to stay inside the brown paper bag and brag about being the least dirty shirt on one half of a seesaw where your debt is crashing is a very vainglorious position to me, because the position to have is in the physical items outside of the brown paper bag that is all as a full set collapsing down the elevator shaft, and your gold and silver bars are up top there. And that is, and even if the theory allows for gold to go up in the end and win, you should be a gold bug then, not a dollar bug. This is where you should be positioned. So the cross trade on FX is gold yen. It's silver yen. I actually think platinum yen, but it's a difficult one to put on, but you can use the dollar as an intermediate. I have certain brokers that actually allow you to do it direct in a single trade. But those are your trades. And it's short debt. And it's always short debt. So we went from 7 cuts to 4 cuts to recently they said, we're getting a bit weak. Maybe we'll have 2 cuts and some will be June and July. Then we had the Fed minute meetings just 2 days ago. And now it's maybe 1 in December. And we've been on the short debt side, and you're going to get less than you think if you get anything at all. If they're already at 1 by December, I'm going to say you're going to get none because they keep undershooting. And what was the big statement the Fed said on yesterday? We've noticed that debt interest rates have lost their power and the economy's sensitivity to them is less. What they're actually saying is we have no one to buy the debt market that's going to push the value of our debt up. Don't forget, there's the chart I'm showing you. As a result, our ability to drop rates isn't there, because otherwise we will have to be the buyer of last resort to get that cut in rates. Because if they cut and make the cut and the market doesn't agree, the market will sell debt and continue to sell it, and they'll be forced to not only reverse their cut, but put rates up. They don't want the market to school them. They have to tie their message to what the market is going to allow. And that's the problem. Everybody thinks the Fed 100% controls rate cuts. The truth of the matter is, if the market ain't buying debt, they don't. Ask the British. They changed the rate twice when George Soros happened, and they had to put up rates to defend in the more recent current when they threw their prime minister and their finance minister under the bus. So in the British scenario, which is a microcosm of what each nation state will encounter, Britain sat there and they were trying to sell debt to pay their pensions. Because they weren't getting sufficient yield to pay their pensions, they had to start selling their assets off. As a pension scheme, that's not a good thing. When you're supposed to be living off the income, you don't start selling the capital. So they had to sell capital, no bid. And they don't want to push the market down and collapse all their assets. So they go quietly to the central bank and say, hey, we're trying to sell some stuff and nobody wants to buy it. And we'd hate to get the mark-to-market price pushed a whole bunch lower by dumping it, because they don't do not-for-profit sales in the debt markets like they do in gold and silver at weird hours. So there was a crisis because money was going to American debt, paying a higher yield and getting a stronger dollar. So the pound started to slip because people sold. The global macro fund manager sells his debt portfolio in the UK. That puts pressure on the pound, and it puts an absence of bid on the underside, and he moves it offshore. So money left Britain, and they did a fiscally stimulative budget to try create, growth. And they weren't going to balance their books. So people saw deficits further coming. So that means more new debt's going to come in, because they're saying, hey, we aren't going to balance the books, but we need to get the economy going. I actually think that was the right thing, funny enough, but the market wasn't going to accept more debt. And that crisis both went down, and the British had a mini moment in that pension failure crisis where pound and UK debt went wrong. So they maybe didn't snap their beam, but they had two really fat kids on both sides, and the beam flexed like hell, and there's cracks in there now, and it flexed to the downside. And then everyone went, hoo, 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 hoo. And that was the panic, and that was the run. So that's the analogy that I'll try, hopefully just help people frame how this crazy system works.
Well, Francis, I think that's a perfect way of picturing dollar versus debt, is this seesaw. And, it's not always the easiest thing to understand for people that are just getting into this, but, that's, I think, a perfect way of visualizing it and understanding it. So when you said we have this, these pieces that are outside the paper bag that are going to be outside of this system, let's move to a gold chart to see how you're seeing this, let's say the master metal, the yellow metal, react at this time to these seesawing forces.
Absolutely. Let's go take a look. Bring it up. You will have noticed, and many of the silver fans will have noticed, of course, that gold has done well, but of late, funny enough, the silver has done better still. So let's get the share going. And we will make a key point on that with regards to the gold-silver ratio, which I'm hoping you'll let me take everyone for a drive-by on. Yes. So from the 2K, in fact, we'll just step out a little bit, because we've spoken together a lot during this process. And I want to remind people how much has already happened in terms of what we've said. So it's been shown to be accurate, but it doesn't happen always at the rate that they've wanted it. I mean, we've been communicating on your podcast, I think, a couple of years now. And we were saying, look, you're in a holding pattern. You're being capped by the 2K. Yes, you trade through it, but you can't hold it. At no point on the weekly did you, on the monthly, my apologies, did you hold above the 2K? And I said, we've hit 3 times. You've had the smallest pullback now. We expect you to break and then potentially support. So now you're no longer at a resistance. You're now at that point where you're sitting on top of the 2K. And that was that key moment there. So we broke. We got slammed down. Everyone will remember that very aggressive selling that took place on that wick over there. That was on the weekly after we'd had our first key run. We made 2,150. Everyone thought, wow, that's a lot. New high, hit a lot of headlines, got slammed. Came back, sat on the 2K, and started winding up. And we said, this is brilliant. We technically traded this as well, because this was a beautiful setup for the upside over here. Again, the blue line being your 2K, that was your setup, and that was going to be a major, what we call an HVF setup, a squeeze of the volatility, and then a run. Big bloated second impulse, very slow, super low vol here, just like you want. It's now getting low volatility. It's above the 2K. It's ready to trot, and trot it did up to there. So now gold has just made a marginally higher high and is looking a little bit tired. And this sell-off that we're getting now at the tail end of the week, of course, as I mentioned, we had the Fed minutes. I think that was there. It's pulled it all back a bit. You got a bit of a rally in the dollar. This is probably going to go into a little bit of a churning. It could do a couple of things. Price behavior wise, you might do that. I think this was quite a strong down leg. You could get brought back into this range over here, which is around 2280 to 2334. Well, we're already there. So 2280 to 2300. You could come a little lower. But the overall genie is out the bottle, is the phrase I'm looking for. And on the bigger time frames that we've given you, when we talk about big numbers, and this is while it's going down, I'm going to throw big numbers for people to focus on, because we've given these numbers before, and I'm going to reiterate them. Just because you're currently in a selling off weekly wick right now, don't forget the goal. So one of the big targets we called for is this 2,897. We've said a couple of times with you, 2.9 and a run into the 2.9s is going to take you to the gateway of the 3K, another key seminal level. And the time taken between doing 1K and eventually running a 2K, don't expect anything close to the same amount of duration before we do the 3K. Everything is getting smaller on the pullback and happening faster. So you are in the parabola phase. Things are getting quicker, but you had to sit. I think it was, we should check. 2011 was when you got 1927. You only went above 2K in 2020. And the year we crossed 1,000, I think it was way back in 08 that happened on the rally. So you went from 08 all the way to 2020. That's 12 years. This is going to be far more brisk in its journey up to the 2897. Further to that, let me say, while we are having this down leg and people are maybe going, I'm not enjoying the current price action, look on bigger time frames. These are the key levels that I'm going to be talking out more regularly. I've only just kind of recapped this recently on our own YouTube channel. So it's kind of breaking views. You're next after you've allowed to run the 3K. So normally when you run a target, you gestate for a while. You pause, you need to come back, you pull back. There'll be a little bit of freaking out at the Fed. They don't like the canary to tweet too loud. You might wind up. And then things will take place that are inevitable in a failing shrinking. So more that air is being pushed out of that bag. It's being driven into the prices of physical assets and in the inflation of their digital world. So that's the clown, the bouncy castle with the two tubes that has the pump attached to it, the second version. And it's also going into the physical things. The next major level that we have technically 6,485. Again, don't expect that in a week or a month after you've run 3K. But these things are getting disorderly. And then beyond that, 7.8. So you're going to be at 8K at some point. In our opinion, technically, just by looking at the big charts. These are logarithmic projections from long-standing technical patterns. And the longer the standing, the more reliable, not the more suspect, the more reliable. So some people will point to this. We'll look at it on the silver as well, almost as a cup and a little bit of a handle in there. There's many ways that you project technically, but the scale of this debt collapse is going to, by the way, it's not the same dollar and it's not the same world while that's happening. Well, it probably will be the same world, just there's going to be a greater realization of the inherent fraud to our financial system by lay people. Mm-hmm. And people are going to be worrying, and inflation rates I expect are going to be higher. And I also expect interest rates to be higher because that debt will have lost value and pensions will be becoming worthless. Eventually, there's going to be, we had 4 decades of search for yield, remember. There was no real yield. You're going to have yield coming out of your ears and devaluing debt markets. Eventually, a certain interest rate being paid to you, if it's above the real inflation rate that you experience, not the BLS number, not some CP lie, eventually it does become attractive. Mm-hmm. And eventually, if you're getting paid 30 or 35%, or 20 or 25%, I don't know where that number starts, 11%, 12%. I think it needs to go, we're going to go deep in double digits for rates. And when I refer back to this diagram, which I had up, which was the 30-year, which is one of the biggest long-term debts, I want to highlight a few things about this chart, Tom. That's going to be super interesting. The real inflection where it started to go crazy is roughly here. I'll put my sniper sights bang on it. And of course, I don't know if you've noticed in terms of the years, but that's 1981. That's the gold high. The minute they released they did the Fiat, what happened in 71? They started going free float. They started explaining to people how it was going to work. We went financialization of everything, no security to any assets. We went full Ponzi there. And 81 was when the gold was reacting to the Vietnam War, the 71 Nixon's action with regards to temporarily closing the window, all the lies they told you then. That whole reaction pumped gold, and you got your $800 way back then when dollars were big currencies. 81, since 81, you got this debt hyperinflation. This is where your parabola started. And the interesting thought is, if it is to return, which isn't an absurd thought, to values once there's no longer that same degree of financialization of everything, that is probably a 95% loss. It's not far off zero. With a bit of overshoot, it could even become close to zero. But at some point, a yield does start to give you real net income that is worthwhile. But initially, people will be so afraid of the loss of capital that they'll panic and they won't be prepared to be buyers. And this is going to go short a lot further, in my opinion. And double-digit rates seem to me an inevitability. And that's part of the seesaw breaking. So it's a different world that you see 7,835, because not only in that environment, the debt will be devaluing on behalf of the currency, and you're going to probably have the currency devaluation too. That could be the snapping point. That is reset when the beam snaps. Britain had it creak and crack, but it didn't fully snap. The Bank of England was able to come back in. They did some token firings and public lashings, and they said, never again, and we'll fix this, and we'll stand it back, and all of that. And they managed to kind of put the genie back in the bottle. But this is a different realm. 7,835 for the gold is a technical target. 6,500 is a technical target, and we've regularly repeated on this channel 2.9. And now it doesn't look so crazy when it's traded 2.5 already, 2.4s. It's not that far off to do 2.897. And I've got the similar for silver for you if you're interested, Tom. So let me know if you'd like me to go into that.
Absolutely, Francis. But I was just going to say, when we look at these big targets like that, what was it, 7,800, things like that, it's worth keeping in mind that is a ratio, right? That is compared to the value of the US dollar. It's not necessarily that gold is that much more valuable. It is value. It currently is value. However, it is also a comparison of how much value your fiat paper has lost at that point.
100%. It's an indicator of devaluation of everything else. Mm-hmm. It is literally the bomber plane, or that all the jumpers jump out of, the Hercules that the parabats jump out of. It maintains height, and it's flying at that altitude, and everyone's spewing out of its bellies. And all the jumpers are the currencies of different world, and the plane holds the altitude. But it keeps getting smaller and smaller when you're a jumper and looking back up at it. So it is elevation retention, and everybody else is hitting the ground. There's no better way to put it. So silver on a similar manner. I was
going to say, Francis, we're basically seeing this $2,000 support level in gold. Do you think that $30 now is the support level in silver now that we've broken that?
Yeah, good question. And you're right to ask around the $30 mark, because it has been seminal. I do think we're going to trade a bit below for a bit, but I don't think silver is going to disappoint in the long run. Let's just get that silver chart up and give you the big time frame view. Silver is one kind of half a cycle behind the gold chart in terms of progress. It hasn't made the new high yet. And the $50 mark is a very important level, and I'll refer to it in a minute. But silver had some structural other levels of great significance that have been leaning on it. So that was the gold high over there. That was Wall Street Bets high, which was tiny bit higher on the silver. And then this was this dotted line, capping descending grind line that we said would eventually break. And it did at the 24.8s. And since then, you've been in breakout. You broke above the 26, which was a horizontal level, quite a soft ceiling on a couple of these levels here. We returned, moved, and now you've taken out all the previous highs. So this is clearly a continuation to the upside. And on most of these structures I've had since I've been appearing with you. So these are not new draws. Mm-hmm. These projections of targets to the upside have existed waiting for the breakout moment. For us, we were on it early over there. Then we were seeing it again on 26 there. You got your return move, and now you've broken all-time since the 2011 highs. I don't want to say all-time highs. I want to say modern last decade highs. with this recent move. We are getting a bit reversed back in right now. I think it can fall below 30 again, possibly, but it's a little bit less. Silver is a little more fresh than gold, but it is also a higher beta. So if gold continued to get battered next week, silver could accelerate a little bit to the downside. But this is really new territory. It's new territory for the last decade. And actually, if we go back up to the super big time frames, we've got this triggering a substantial pattern. I'm going to put 2 months on here because this is almost too much time. A substantial pattern. And this is giving us, again, big projections. Many traditional technical analysts will draw you a cup and handle on this silver chart. Because of the relationship with 50 there, and close to the 50 there, this is a huge multi-year. So that was 79 all the way up until 2011. Mm-hmm. Quite a lot of years it took to do that. 21 and 11, it's about 32 years. Now this handle is turning abruptly. It started its turn. We had the COVID flush out there. Then we had 3-year rest, but this is now breaking into new highs. So I see this coming up to that same 50 mark, and then having a rest. And we've got a 38 target here for you and a 44 target that are all part of these lower time frame upside moves. So that pole being projected from that low, we're getting a couple of these. So it's got a couple of targets to run there, and then you're going to be probably in and around what I'd say the mid 40 to that 50. That's a special resistance. Now, I'm not going to tell you everything you want to hear. I think we fail at the 40 to 50 one more time. So it's always 3 rejections normally. There's your 80s rejection, early 80s. There's your 2011. And we will have a 2024 or 2025 $40 or $50 rejection. I would take some profits off on trading profits. I wouldn't sell investment. I would take trading profits off in the range of 45 to 50 on a lower time frame. I'll be watching the momentum there. But I don't think you go away for long before you come and you break, and then we're off. And that's where I see a 302 projection. And that comes from an HVF target that we have had. That's the biggest number I've ever mentioned here. And I think it captures an entire financialization of everything era that comes to an end and sees a absolute historic of multi-decade significance 50 level break. Everyone thinks 30 is a big level. 50, if we meet it for a third time, has been the nemesis, and I think we fail for a third time. So I'm not the super bull that just says, no, new highs, new highs, new highs, but that it won't be long before it's back up. Much like gold did when it broke the 2000. It failed 3 times. It broke the 4th. It just had a short dip down. It didn't take long. It came back all in the same year. But you probably have to do something. So this is not necessarily even to scale. It could be something like that a lot sooner. So I'm not implying that late in time, but a small little return move. So take it back, buy it back a little bit cheaper again on your trading account, and then trade for a $300 advance. And again, that's going to be tied to 7,800 potentially gold. So you can do the maths on dividing out what your gold-silver ratio is. One of the big triggers, as I seamlessly pass on to the gold-silver ratio there, Tom, if you're ready for me to take you there, is one of the triggers we mentioned that needs to fall was the gold-silver ratio. We spoke many times with you about this, and literally the entire period that we've been discussing, it's been contained by that basing ascending dotted red line there. And for most of it, it's been during this period here.
From basically, let's say November 22 to April 24.
Yeah. And we've been constrained. And I've said, Tom, we're not going to have the major moves we want until that basing ascending grind line breaks to the downside. And I said, we're not breaking to the upside out of this. On balance of probabilities, we are expecting a downside break, and it will be bullish, and it will be the beginning of silver starting to realign with gold. And that is absolutely started to happen. A key 30 level has has fallen, it's going to get tested. We'll probably get into the 28, 29s again, one or two more times at a wick level. But now that Holy Grail is broken, and you will probably note this came to the 75. I'd already marked this as a key round number I would expect us to fall. And I've also warned many times, even when it happens, you can get a short-term return move before making new lows. But the next key level of real significance is 65, and we've touched the 75, which I kind of expected to be the place. We've done this analysis before. Again, this blue line's been on all our previous videos, and it captures that low as a bit of a soft floor. So the 75 is serving as a bit of a soft floor since getting back up above it back in July of 21. So we're at a bit of a soft floor, but we've just taken out a major level, and that's disorderly decline, and that's driven both up, particularly silver. So silver's starting to correct. I think the 65 brings the silver, and the mathematics we did together once before, the 65 neckline, so to run the 65 neckline is going to bring silver to that 45.50 gateway, I think, for me. So you'll probably run maybe a 60 or a 61 in some of the momentum running through that. And at that point, gold will probably be at its 2,900, maybe call it $3,000 for want of a better number. And if you're at a 60 PE ratio, I call it PE ratio, gold-silver ratio, and you're at the $3,000 gold, you can calculate what your silver will be. But if you divide $3,000 by the 10, you're on 300 divided by 6. It's kind of $50 silver, isn't it? So 65 is going to be somewhere between $45 and $50 silver. So I love it when you see the patterns on the cross-valuation tie up with the technical targets that you're expecting on gold on the upside and silver. And that's when you bounce again. So then we come back up. Gold-silver ratio will go up a bit. Silver will come back more than gold. Gold will hang on a bit more, but will still pull back. And then we wait. And the next run after that is the run of the ages. Because that's where we define 5 stages of a breakout. This is just the initial breaks. The real break of this head and shoulders target that we have on a massive level is going to take you right the way down to 30. So when you go from 65 down to 31, 32, and this pattern, that's that purple line down there, and it requires a lot more of the pattern to the left for everyone to see it. But 32.8, you're getting at about a third. So now you've gone from, at one point, 128 ounces of silver to buy a gold ounce to 32. It's still got lower to go, in my opinion, after that, but that's going to be a big target run. That's a third of 100. So if gold is now sitting at 6.5, and you're at a third on silver, you can calculate the next silver price potentially. So if you're at 6,500 gold and you're at 1/3 of 100, well, you divide by 100, it would be 65. So you multiply the 65 by 3, 180 plus 15. You're going to be at $195 silver when you're down here potentially. Everyone's going, what? We're barely holding on to 30 and we're turning down on a Friday below it and all of this crazy numbers. But people forget how far we've come. Gold's at a new high. Gold's, for want of a better number, it's already midway between 2,000 and 3,000 already. It was 1800s and falling to 1600s for revisits at one point. Now it's 2.5.
Yeah, exactly.
You know, it's happening. And silver's broken $30. It's happening. And it's not even a big fuss. Go check Google Trends. No one even cares or notices.
Zero.
This isn't even registering. Wall Street bets at much more hype and went less high. So this is a no hype. No one cares or notices, apart from people like me and you and the viewers now, right now. This is small beer. And the other things I want to add to the story, Tom, that we don't always find ourselves talking about is something like an industrial metal such as high-grade copper, which we've also called long, and as part of the 3 ETFs you can buy as part of your inflation hedge. Now, you can see a bit of a slam coming in there, and lots of people making a big story about how it's getting slammed. Well, it's going to get slammed by that amount.
It was
all the way
the
up.
largest one-day decline in nearly 2 years, right?
Yeah.
Mhm.
But I mean, they're always going to look for statistics there, like that. But it's after doing this. It's like, check at that pullback, You've just gone from, there's a low there, but let's go from a recent low. Whoops, let's measure. You jogged up 42.24%. And now you've come down 8.73%.
Mm-hmm.
And all the headlines are about biggest decline. And I'm going to go, well, you're going to have biggest declines all the way up through our targets of well through 6 into double digits on copper. Now, I will say copper is a construction and industrial use. And if the consumer is as wrecked as I think it is, both energies and copper might be relative underperformers, but they're still going up. They just will have bigger pullbacks along the way, but these are all going up. This is money devaluing that you're charting here.
Against real goods.
Against real physical goods that you can't print.
Mm-hmm.
Money that can be printed and digitally conjured. Mm-hmm. So that brown bag of deflating, dying, totally end of Ponzi scheme era tokens. They're literally monkey tokens, vouchers. Monkey money versus real physical things. You should be getting rid of all monkey money for real physical things, because I'll buy physical things off you and I'll take gold and silver for them, and I will sell things for gold and silver. I don't want more monkey money. That's deflating at a chronic rate. We're in the parabola phase of debt devaluation and fiat devaluation. That's why everything's going up. That's why coffee. They had the same headline on coffee about coffee going down. The Robusta bean, biggest decline, the Robusta. And I'm like, okay. In its way from absolutely moon shooting since the COVID lows down here at a low of, and I need to move our collective handsome heads there out the way, of 1,118. Massive collapse. Okay. You went to 4,300 and you dropped down there. Well, you're already bouncing back and you've closed that gap. It's going to go higher. These are all giving upside targets. And the amazing thing about this is people love to confuse you. The macro trends are your friends. Mm-hmm. We were on it. It was our first call. The debt turned. That is the beginning of the death of money. That means commodity bull starts. So everyone thinks you're negative. You're talking about debt going down and economies disappearing and money. No, commodity bull. That's how you make your money. You trade commodity bull longs. Even where I think there's a consumer element in it, you're still going to go up. I prefer not to be in oil. I prefer to be in the monetary commodities, because we're replacing a monetary system and everyone's going to want to hold something that has real history as a monetary alternative to fiat, monkey money, token paper. So play the gold and silver rather than oil. The gold, silver, oil ratio will pivot strongly in the monetary metal, but you're getting soft commodities here. That's short of a major destruction of population. People are going to still be drinking coffee, still needing to do all these things. So softs, I'm happy with. Energies, just watch them a wee bit, but generally they will also be going up.
So, Francis, when we're seeing these gaps down and these behaviors in the price action, like in copper, like in coffee, is this, in some ways a function of the new scale of these higher highs, right? This is almost the way I'm thinking about it is that it's a new proportionate down for the larger graph in a way.
Yeah, so I think you're referring to commodities making higher highs, and I actually think that's a beautiful way to describe it. There will be. This is why we talk about this. What you're witnessing is stagflation. There's a consumer stagnation, which means low growth, high inflation. The inflation is pushing the prices up. It's actually the devaluation of money, but just go with a traditional phrase, I suppose. So it's inflation's pushing the prices up, but the consumer is stagnating because he's getting lower increases. His money is buying him less. And the economy, remember the two halves of the balloon, as I explained it, for you, the man in the street, not Lockheed Martin, which is, not far off highs, not British Aerospace, not even Boeing, that has military industrial complex component, despite their plane that's falling apart. They're doing great. Mm-hmm. They're doing great. So the stag nation is the average man in the street who does an average job, who isn't with the status businesses, and doesn't have specific unique skill sets that are highly sought after, maybe in the tech space, et cetera, cryptography and various other things. Mm-hmm. So it's going to feel terrible, yet the market, stock market, commodities markets are all bulls. That's the fact. So for traders and speculators, this is the big long on commodities and the big short on debt and fiat monkey money.
Yeah, it is a process that is going to take time to play out. But going back to what we kind of originally talked about here, stepping back, being able to understand where this is headed, understand where these macro forces are going to be pushing, I think the entire commodities complex, this is just an adjustment to the amount of paper monkey money that has been shoved into the markets, and now these real goods have to absorb.
Yeah, I'd agree with that. I'll show you something else that was interesting. We gave this to the community. It's now no longer, but just as an example of the two balloon explanation. Parcels company. When do parcel companies do badly? Well, we charted for a short here on the UPS shares, and I gave this to my guys before this broke when we were up here. And this shows 117. You could have got in at close to 150. That's a third, loss of a third. What do? They move parcels around. What's not happening that they don't get to move as many parcels around and make money? My guess is demand. Folks aren't buying stuff that need parcels delivering. That's why they go down. So that's the man in the street stagnation. Your credit card's maxed out. You've got record credit debts. The average rate being paid in the US is 21% on credit cards. Credit cards are the emergency finance. It's the finance you lose last. If you've got space on your mortgage and you can extend your home finance, you'd rather pay property rates than pay 21% rates. So you're talking about distressed consumer. And then you're getting a package company in a bunch of charts that I'm all showing you going up, just making higher highs, higher lows, that you should all be long. Coffees, gold, silver. I want to mention platinum as well. And if you've got time, I'll take you past it. Mm-hmm. And then I'm showing you a parcel equity that's going down, but the general equity market will go up. The general equity market will go up on the companies not doing that great, that just hold their own on the devaluation of money principle. Everything is going up just to stand still. The things that are going down are things that are inherently reliant on the wrong half of the economy. Parcel deliveries for consumers, retail, consumer, that's going to go down. Look for downside setups on equities there. They're going to be right-sizing. But longs are the best game, because if there's any business that's remotely just holding its own, it's got to go up, because the basis of measurement is going down. If you can find some thriving businesses that are counter-cyclical, that maybe deal in bankruptcies or foreclosures, sales of second-hand items, pawn shops, whatever cycle, low-income supermarkets that do low-cost, Costco's, those kind of things that are deemed utilities, defensive things for weak retail and consumer, those things could flourish, and you're going to get your currency effect, your devaluing currency effect as tailwind, and the stock market's going to continue to surprise. But it's not my favored market. I'm like the commodities guys, and the monetized ones first, gold and silver. Miners are going to start to come around. You've already seen a bit of that. and I think you're going to see a lot more.
Mm-hmm. Absolutely. Do you want to take us past platinum real quick, Francis?
Yes, indeed. So I've been making the case actually for platinum, and it's spoken about less. It's a little bit of a frustrating one for some people to buy. In some countries, they still apply VAT to it because they treat it as an industrial metal. It's obviously a precious industrial metal, but this is our framing for platinum, and it could have spells of overperformance. We think platinum could do a 3x relative performance to gold. And we also see it similar, beating palladium, and we even think it could do in spells better than silver. It's at an early start point. This was one huge falling wedge. I'm just going to stick that back on log scale there to correct the chart a little bit. It broke out, it pulled back. It's now in this squeezing, winding up structure. If you're in a country, I don't know how the US treats it, so I'll stand down on that one. I don't think you have VAT on platinum. So there's 1/30th of the amount of platinum than there is gold. Mm-hmm. It's 30 times more rare. I think they get 190 tons out a year. That might sound like more than the 30th, but generally with all that's above ground and everything, that's the number I've been given from my research. And the places that dig it up are South Africa and Russia. Plus, platinum got hammered with the reallocation towards palladium, which saw palladium have disproportionate runs and platinum no longer be sought after. Palladium is inside the platinum group of metals, of which platinum is one of the metals and also the name of the group of metals. And I'm seeing, you start to see a little bit of more circumspectness to the battery car story and narrative. Palladium's been badly hurt by that. You could start to see recovery. You could see more jewelry requirements for platinum. It's less obvious of wealth. Maybe having obvious wealth is going to become a problem when there's a lot of people that are short. It looks like silver, who knows? But anyway, I'm speculating. I think this is going to overperform. That's on the monthly. And if I look on the weekly chart, we're in a nice squeeze. I highlighted it already in the pink, but we can do a lower time frame look. It's also, for me, just triggered a nice break. This is our first setup in a new trend on the weekly side. And we always see these overperforming. It's a seminal one. So I'll just show you that. So of the others, like rhodium, platinum, palladium, platinum is our choice. We've just run that high with a really strong trigger. From the monthly time frame, this was the big deval of platinum, relative valuation. Mm-hmm. Really, really falling out of affection and use, and palladium eating its dinner to a large degree. And then that's the monthly. So it's actually been since 2009. It's been in that unwinding relative value to all the other major metals. And now on the weekly side, we've got this interesting structure over here, which is, since it's broken out its falling wedge, it's just taken its third high out there and having a little pullback and revisit. That's a great entry for me, for most people, for platinum. And I see 1,500 and overperformance to that. So I'd only do a partial close, 1,583, 1,600. Mm-hmm. And if you allow this, I'm going to do some cross valuations for you on platinum and show you why I say I think against some of the other precious metals, it might actually really overperform. So if we do it against gold, we do the gold futures. So what we're doing is we're taking a platinum ounce and we're dividing it by the gold ounce. Mm-hmm. So I've got this in log scale. This is platinum compared to gold. So we're dividing the relative valuation between the two. It is in log scale. So the orange line is actually the midpoint. So I'll just take it off so that you can see that. So what have I done? What are those red and green lines in that analysis? So updating my community for the relative valuations of platinum. Platinum, as you can see, for most, before we went into the the post-dot-com world, platinum most of the time was at least 1 ounce of gold, and right up at this point at its absolute high here, almost 2.5. You needed 2.5 gold ounces to get a single platinum. Dot-com came, it's financialization of everything, the internet changes everything, and also similar time, I think, with some of the catalytic converter changes, etc., you went from 2.5 or just sub 2.5 right the way down to 0.3. You needed 2.5 gold ounces to get a single platinum ounce to suddenly only needing 0.3. Now, as a relative valuation for something that is far more rare, far more difficult to find, and in far more precarious nation states for securing supply chain, that's pretty interesting. And what I will highlight is whenever you've been in these extreme undervaluation phases, you've often had very, very violent surges come about in cross-valuation. And you're at a localized low where you bottomed previously in 2020. That was the events of COVID. That was the extreme undervaluation of platinum. You're there and you're turning up. Watch this against silver. So I'm taking the same metal, platinum, and I'm just showing everybody you could get to the 1.5, in other words, 50% plus over a gold ounce, the red lines that I was just showing you, very, very easily. And that's in a gold price that is really, really high. This is platinum against silver. This is a 3 impulse falling wedge.
Yeah, it's interesting to think about, as you said, that undervaluation over time and then how that ends up breaking to the upside.
And you've got a bottom here as well, Tom. Yes, you've got a bottom. I think it's basing. This breaks that level. Platinum starts to seriously, seriously overperform. And, for us, that's going to be a really interesting moment when that comes about. And then you can do it even on palladium, which is its stablemate. It's already begun a degree of recovery against its stablemate, but it has been before 5.5 of a palladium ounce. It's only at 1 now. So if it goes from, if we have a broad spoke bull market, platinum could, I would expect new highs. So I would expect it to actually take out this level, but let's just say it made that 5.5. It would 5.5 times outperform whatever palladium is doing.
Right.
Which is, it's potentially substantial. And we compared it to silver. So in all instances, I think it's another one for those that, especially if you can buy it without the VAT, which is probably people stateside. I don't think you have an additional cost. But even if you do, if you're getting that additional multiple of overperformance, you're going to go from, 50% of a gold ounce to 1.5 of a gold ounce. You might not care about 15% entry cost on the front end if you're getting a 1.5 multiple on whatever multiple gold does. I've thrown out a target of 7,800 for gold to get from 2.4 to 7.8, and a 2.5 essentially to 8,000. That's 3 times. And if you're going to get a 3x on 3 times, you're going to get a 9x on your platinum while gold does 3x. So that's something to consider. For those that want a little bit of extra diversification. It's less of a monetary metal, though, so you won't have the legal protection of, I don't know if you'll have the legal protection of coinage unless you buy it in coins, because it's less of a monetary one. So there are other things to consider in all of that.
Excellent, Francis. Well, I appreciate you walking us through how you see all of these things, and especially on your targets. I know that's a system that you have come by over many years of looking at these charts and working with them. So I really do appreciate that. Of course, for anybody that wants to find more from Francis, all his stuff is available at themarketsniper.com and of course on Twitter as well at themarketsniper. Francis, is there anything that you'd like to leave our listeners to think about?
Yeah, usually we sign off like we started actually, but enjoy life, do all those good things. Our core focus is how do we remain authentic, remain principled money, principled people, pursuing wealth building and wealth preservation during an absurd economic case history time. And I'm very aware of what I've described in my sort of, mental mind, visual models I painted with my hands here. I will try actually get some diagrams out, which will be fun. So if the guys are following the YouTube channel, they'll see those and on X. But that is a unique skill set. If you can come out of these times, make your money work for you, preserve it and retain it, and do all of these things well, you will actually be wealthier. There's a huge opportunity in doing this obstacle course, actually. Completing this obstacle course successfully, gamify it, find a way to enjoy it, take action, and that's my primary goal. How do I help people live a great life, be happy, be in themselves, go and do those big experiences so that they have plenty of time to enjoy their money in an environment where actually they're destroying money, but there's so many opportunities for you to absolutely kill it to the upside because of that. Not be a victim of your environment. Choose your responses. Allow me to help guide you with that. And that's our core goal. Build your best life. Go and grab those experiences, build your wealth, preserve it, and enjoy doing it. And that's what we're about.
Excellent. That's a perfect way to sign off, I think. Francis, thanks so much for your time today. Always appreciate it. Always appreciate the chat, man.
Thanks for having me on, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.